Hello there, and welcome to the third quarter 2024 video review of the iSectors Post-MPT Allocations. My name is John Koch, iSectors Senior Investment Analyst, and I am joined by the CEO and CIO of iSectors, Vern Sumnicht. How you doing, Vern?
Good, John. Thank you. I just want to say you've done a great job on this model, and I think some of the improvements that we've made over the last year are really starting to show some great results, and some of the research we're doing now, I think, will continue to show great results. I'm going to just let you handle this and tell people what we've been doing and tell people what the results have been.
That sounds good. Thank you, Vern. Okay, so we'll get started by looking at each model's current allocation and show the changes in their sector weightings since last quarter. As you inspect each model's current allocations, I'd like to point out the gold bullion and technology weightings in each model. As you can see, they're the only two sectors that have held a greater than 25% allocation in each of the past 6 months. In fact, they've had that allocation most of the last year plus. And in any iteration of recent runs of our quantitative algorithm, these are the two sectors that consistently get pushed to the top. So with that in mind, we'll spend the rest of the video looking at why these two investments are so important to the model in our current market environment. So first of all, looking over the last 3 years, of all the current investments in the post-MPT models that have a greater than 0% allocation, technology and gold have been the best performers in those 3 years, as you can see in the black box in the chart shown here. Then this next slide shows a cleaner view of technology and gold overlaid with each other over the last 3 years. And as you can see, they ended up in the same place without their pattern of returns matching each other during those 3 years. What's more interesting, perhaps, is that when you dig deeper into the risk metrics of these two investments in that same time period, represented by the Aberdeen Physical Gold Shares ETF, ticker symbol SGOL, compared to the Fidelity MSCI Information Technology ETF, FTech, you'll see that gold has been able to match technology's returns with much less volatility. It has a lower standard deviation, higher Sharpe, Sortino, and Kalmar ratios, and lower maximum drawdown over the last 3 years. Now, that's not bad for the last 3 years, but what about more recently, when the post-MPT models have had the most heavy investment in these two sectors? Well, when you look at returns year to date, it's a similar story, except that gold over this period has actually outperformed technology. The risk metrics tell a similar story as well, with gold exhibiting lower volatility and better efficiency ratios once again. All of this against the sector that has been driving almost all of the returns of the bull market over the last 2 years, off the lows in 2022. These two investments work very well together, and if you take it back 10 years and would compare a 50-50 gold and technology blend versus the S&P 500, the blend would have outperformed the S&P during this time period with less risk. Almost any other sort of blended or balanced portfolio has not been able to keep up with the broad market during this period, at least without taking on additional volatility to do so. So what is it about these two investments that has proven beneficial to investment portfolios? Well, gold works as a diversifier and has earned these solid returns with a very low correlation to tech stocks, almost a zero correlation, in fact. It's only been about 0.04 correlated to the technology index over the last 10 years. Gold also works on as a hedge on multiple levels, which is crucial in this current investment environment. It hedges inflation. Gold performed well during the last inflationary surge in 2021 and 2022, and it's poised to perform well again if inflation resurges in the face of increasing money supply and additional interest rate cuts by the Federal Reserve. It also hedges geopolitical risk, which is becoming more and more important every day as the headlines get worse and worse in the Middle East. We saw central banks like China buying hordes of gold. The price of gold spiked both when Russia invaded Ukraine in 2022 and when Hamas attacked Israel last year. And it can also hedge against recession, performing better than most asset classes, both during the Great Financial Crisis in 2008 and the COVID recession in the first half of 2020. Technology, on the other hand, almost acts as a hedge in the opposite direction. It hedges the market going up. It's the only way our model really can access potential continued strength of the stock market, most notably in the Magnificent Seven stocks that have driven most of the returns over the last 3+ years. If these companies continue to innovate and grow through AI or just other advancements, an investor almost needs exposure to them if they want to keep up with the broad market. And so there are, of course, other investment options in the iSectors post-MPT allocations. And if the economic environment changes, the model will adjust to take advantage of whatever comes next. We'll be sure to keep you updated if anything does change, and make sure to stay tuned to our website and social media channels to stay on top of everything iSectors related. Here's our contact information. Please don't hesitate to reach out if you have any questions, and have a great day.